Okay, welcome to the deep dive. Our mission here, well, it's pretty simple. We take a stack of source material, really dig into it, and pull out the absolute key insights for you.
Yeah, basically giving you a shortcut to being well-informed on the topic.
Yeah.
You do the wading through, you get the essentials.
Exactly. And today, we're diving into something really foundational for anyone interacting with markets, and I don't just mean hardcore traders.
No, it's broader than that.
Our source material is from a YouTube series, #ESO Isagoiza, and we're focusing on excerpts about a book many call the absolute Bible of trading psychology, Trading in the Zone by Mark Douglas.
Oh, it's definitely essential reading. Mark Douglas, he worked with traders at every level, from retail guys to institutional players.
And his central argument is kind of revolutionary for some. He says success isn't really about finding the perfect analysis method, fundamental or technical.
Right. It's much more about what's happening inside your own head when you're making those trading decisions, your mindset, your psychological state.
And just to clarify, while the title says trading, Douglas really emphasizes this applies across the board: investing, trading, short-term, long-term.
Doesn't matter. The psychological component is always there.
Yeah.
It's not optional if you want consistency.
So yeah, forget the magic indicator for a bit. We're going into the early chapters here to explore why psychology is just so crucial and how our own minds can be our biggest enemy or maybe our biggest ally.
Let's start with that first big revelation. Douglas talks about this idea that ultimately psychology trumps analysis for consistent winning.
Okay, yeah. Let's maybe track the history a bit, how people thought about markets. Way back, it was basically all fundamental analysis, right?
Pretty much. You were like a detective, digging into company reports, earnings, debt, the economy,
Yeah.
trying to figure out the true value of something.
The whole intrinsic value idea. Find it, see if the market price is lower.
Exactly. Get that margin safety. Classic value investing approach.
But then things shifted. Technical analysis started to emerge, became more popular, maybe around the 70s.
Yeah, around then. And initially, a lot of the old school folks thought it was, well, basically witchcraft.
Right. Looking at charts, patterns, past price action, it seemed totally disconnected from the actual company or asset.
But the interesting thing is why it caught on. It turned out to be, well, more practical for shorter term moves.
How so?
Because it directly reflects what traders are actually doing. Their buying and selling pressure is what moves the price short term, more so than the theoretical intrinsic value sometimes. And honestly, it gave more frequent signals, more visible results, you could say.
Okay, that makes sense. But here's the kicker, Douglas points out. Even with all these technical tools, most traders still lose money consistently. Why? If the tools got better.
Well, think about it. Fundamental analysis. It often ignores the collective psychology, the herd behavior that drives prices day to day.
Right.
Technical analysis sees that behavior in the charts, but it doesn't help you manage your own behavior when you're in the thick of it. The methods are about the market, not about you.
Ah, okay. So the missing link is the mental game, mental analysis, understanding how you think and react under pressure.
Precisely. So the big takeaway from Chapter 1 is, you need a strategy, an edge, yes. But that's not enough. You absolutely need that third leg of the stool, the psychological mastery.
Which leads perfectly into the next part. Why trading is so appealing, so seductive, but also why that very appeal makes it incredibly tough psychologically.
Oh, the lure is powerful, isn't it?
Yeah.
It's promise of, total freedom.
Yeah, no boss, work from anywhere, make your own hours.
And the potential for unlimited profit. At least in theory. Plus the excitement, the challenge.
The ego boost when you nail a trade. It feels like this wide open space with no rules.
But that's the paradox Douglas highlights, that exact freedom, that lack of structure. That's what makes it so hard.
How come?
Think about our lives. From day one, it's rules, structure,
Right.
parents, school, jobs.
Yeah.
We're conditioned to operate within boundaries set by others. Then you enter the market. Complete chaos, relatively speaking. No one telling you what to buy, when to sell, how much risk. And our ingrained reaction is often to resist imposing rules on ourselves.
Because it feels like losing that freedom we came for.
Exactly. We want the utopia, but trading without self-imposed rules is just, well, it's like driving recklessly without traffic laws. It ends badly.
And this resistance, it leads to some common psychological traps, right? Like taking responsibility.
Oh, yeah. That's a huge one. Every click, every trade in your account, you did it. But when it goes wrong,
It's the market's fault. Or the news, or my broker.
or the whales,
Yeah.
anything but admitting I made a poor decision or I didn't follow my plan, it's psychologically easier to blame something external.
But Douglas insists, and this is crucial, you have to take 100% responsibility, wins and losses. Otherwise,
Otherwise, you never learn. If it's always someone else's fault, you don't analyze your mistakes, you don't adapt, you just keep repeating them. It's fundamental.
okay, what other traps? There was something about random rewards.
Yeah, the addiction to random rewards. He uses this analogy, like the monkey experiment. Give a monkey a reward randomly for doing something.
And it keeps doing it erratically, hoping for another surprise.
Exactly. And he says beginner traders often fall into this. They get a few lucky wins early on, maybe pure chance, no real strategy.
And that feeling is addictive.
Totally. It convinces them they've got the touch, leads to chaotic, planless trading. They're chasing that random hit, that feeling, instead of building a consistent process.
And then there's the reliance on, like, external control, expecting the market to do what you want.
Right. We're used to situations where we can influence outcomes, or at least follow external guidance. But the market, it's completely indifferent.
It doesn't care about your position or your hopes.
Not one bit. It just responds to the sum total of everyone's actions. So you can't control the market. You can only control yourself, your entries, your exits, your risk, your reactions. That's where the work has to happen.
And failing to manage all this stuff, that's what leads to the boom and bust cycle.
That's exactly it. So many traders learn enough technical analysis to make some money, maybe even have a great run.
Yeah, they feel like geniuses.
Right. Ego takes over, euphoria sets in, they get reckless, bigger positions, ignore their rules, and then boom, wipe out all the gains and often more.
Douglas saw this over and over, didn't he? That struggle with ego and taking responsibility.
Yeah, his experience really drove home how central these psychological issues are. It's like the market's primary filter.
Which brings us to, okay, how do we build resilience? Taking responsibility and achieving consistency.
Right, so building on that responsibility point from Chapter 3, it's not just a suggestion. Douglas frames it as an absolute prerequisite.
You initiated the trade, you own the outcome, period.
Exactly. And yes, it's hard because owning a loss means feeling that psychological sting, that discomfort of being wrong. Deflecting blame feels better short term.
But it prevents learning.
Completely.
Yeah.
You have to accept that pain, analyze it objectively, and use it to improve. He uses this really powerful metaphor.
Yeah.
Think of yourself as a sculptor. You're trying to create the ideal trader version of yourself. Your current habits, beliefs, fears. That's the raw block of stone. Your desire, your willingness to learn, your discipline. Those are your tools.
Your hammer and chisel.
Right. You are actively chipping away at the unhelpful stuff, consciously shaping your inner self, your mindset, your reactions. It's an active, deliberate process, not passive at all.
I like that. It emphasizes the effort required. And this sculpting, this self-work, it leads into Chapter 4's idea about consistency.
Yes, that consistency is fundamentally a state of mind. This is a big shift for many people. We think consistency comes from finding the holy grail strategy.
But Douglas says no.
He says consistent profitability is the result of achieving and maintaining a certain kind of mental state, a stable, objective, disciplined state.
So the best traders aren't necessarily smarter, they just think differently.
They think in ways that allow them to execute their edge without getting thrown off course by fear or by euphoria, by overconfidence. They've cultivated emotional neutrality while trading.
It's like a genuine happiness, right? It doesn't come from external events constantly making you happy.
Exactly. That's fleeting. Real contentment comes from within. Trading consistency is the same. If you need the market to constantly give you wins to feel confident, you'll be emotionally volatile.
So you build the internal state first,
Uh-huh.
based on principles, realistic expectations.
Yes. And when that internal state is solid, executing your strategy becomes much easier, almost automatic. You're not fighting yourself anymore. Trying to force consistency externally just doesn't work long term.
Okay, and the two big enemies of this consistent state are fear and euphoria.
The twin demons of trading psychology. Fear is paralyzing. It makes you second-guess good setups, miss entries.
Or cut winners way too soon because you're scared of giving profit back.
Right. Or the classic one, holding on to losers way past your stop loss because you just can't stand taking the loss, admitting you were wrong. Fear of regret, fear of failure. And euphoria,
Yeah,
the flip side.
just as deadly. A few big wins, a winning streak. You feel invincible, like you can't lose.
Midas touch. Yeah. And that leads straight to recklessness. Bigger bets, trading random stuff outside your plan, ditching risk management. And that's how the bust part of the cycle happens. Give it all back, and then some.
Douglas's categories are pretty stark, aren't they? Like less than 10% are consistent winners.
Yeah, something like that. Then maybe 30, 40% are consistent losers. just bleeding money slowly or quickly.
And the biggest group, over half.
Stuck in that boom and bust loop, making money, losing money, never really getting ahead consistently. The goal is obviously to escape that loop and join the small group of consistent winners by mastering fear and euphoria.
Which means we need to talk about how we actually see the market, perception, and embracing uncertainty.
Exactly. Chapter 5 on perception is fascinating. The core idea is that market information itself, price going up or down, is neutral. It just is.
But we don't experience it neutrally.
Not at all. We project meaning onto it based on our beliefs, our current positions, our past experiences, our emotional state.
So the same price chart can look completely different to two different people.
Absolutely. A professional might see a dip as a great buy opportunity, according to their plan. Someone else holding a losing position in that same stock sees that same dip and feels panic, dread, maybe denial. Same data, totally different perception.
And our past trades heavily influence this, like getting burned on a certain stock makes you fear it forever.
Or the opposite. A stock made you a fortune once, so now you have rose-tinted glasses for it. You hold on to it even when the technicals look terrible because you're filtering it through past success. These experiences build mental filters.
He uses that simple analogy, the boy and the dog.
Right. If you strongly believe there's a dangerous dog outside, you might interpret any ambiguous shape or sound as the dog. Your belief shapes your perception of reality.
So in trading, we need to kind of debug our mental software, identify those faulty beliefs or emotional triggers that distort how we see the market.
That's a great way to put it. Beliefs like, I always buy at the top, or this market is rigged against me. They literally change what you pay attention to and how you interpret neutral price action.
The goal is striving for objectivity, mental neutrality.
Yes. Seeing the market as it is, not as you fear it is, or hope it will be. Detached observation. Professionals work hard to cultivate this.
And a huge part of achieving that objectivity comes from Chapter 6, embracing the market's fundamental nature, which is uncertainty.
This is massive. Douglas calls it the uncertainty principle. You have to develop a core, unshakable belief that the outcome of any individual trade is uncertain.
Anything can happen.
Anything can happen, not just intellectually knowing it, but deeply integrating it, so it governs your expectations and reaction.
How does that help? It sounds a bit scary.
It's actually liberating, because it means you stop trying to predict the outcome of the next trade with certainty.
Yeah.
You accept it's unknown. Professionals do this.
So they don't get attached to the outcome of the current trade based on the last one.
Exactly. They don't think, this pattern worked 3 times, so it must work the 4th. They know each moment is unique.
Yeah.
The overall edge plays out over many trades, but the next one, random outcome within that edge.
Whereas most traders, their feeling of risk goes up and down with every win or loss.
Totally. Win a few, feel bulletproof, take more risk. Lose a few, feel terrified, can't pull the trigger on a valid setup. Their decision-making gets whipsawed by recent outcomes because they haven't accepted the inherent uncertainty of the next outcome.
So professionals detach. They treat each trade as just one instance in a long series.
Precisely. They accept any outcome as possible this time, even if their strategy has a 70% win rate historically. That 30% can show up right now. Accepting this uncertainty is what gives them mental flexibility.
They aren't shocked by unexpected moves.
Less so. They can adapt, manage the position, maybe even reverse if needed. They aren't mentally locked into needing one specific outcome. And critically, you don't need to know what will happen next to make money.
You just need a plan based on possibilities, probabilities.
Exactly. Which leads directly into maybe the most powerful concept, thinking like a casino, thinking in probabilities. Chapter 7.
The casino analogy. I like this one. How does it work?
Well, think about a casino running a blackjack table. The outcome of any single hand is totally random, right? You might win, the house might win.
Yeah, unpredictable in the short term.
But the casino doesn't care about any single hand. They know that over thousands, millions of hands, the rules give them a small statistical edge, maybe 4.5% or something.
And over that huge sample size, that small edge guarantees they make a profit.
That's the key. They have an edge, and they rely on a large number of events, hands dealt, for that edge to inevitably play out. Consistent profit from random individual outcomes.
So a trader needs the same thing, an edge and lots of trades.
Essentially, yes. You need an edge, a trading strategy or method that over time has shown a statistical probability of producing more profit than loss. Maybe it wins more often than it loses, Or maybe its wins are much bigger than its losses.
And the second part.
You need to execute that edge consistently over a sufficiently large sample size of trades for the statistics to work in your favor. You can't judge your edge based on the last 3 trades.
So stop obsessing about whether the next trade will win.
Yes. Trust that if you execute your edge properly over, say, the next 50 or 100 trades, the probabilistic advantage will show up in the net result. Shift focus from predicting the single outcome to managing the process over many outcomes.
Douglas boils this down to the 5 fundamental truths about the market, right? These seem really important.
They are foundational. You have to really work to internalize these.
Anything can happen.
Okay, we talked about that. Uncertainty.
2, you don't need to know what is going to happen next to make money.
Because you're playing the probabilities, not predicting.
3, there is a random distribution between wins and losses for any given edge.
Meaning you could have 5 losses in a row, even with a winning strategy.
Absolutely. Or 10 wins. The sequence is random over the short term. 4, an edge is nothing more than an indicator of a higher probability of one thing happening over another, not a guarantee.
Just tilting the odds slightly in your favor.
And 5, every moment in the market is unique. Past patterns don't guarantee future results for this specific moment.
Wow. If you truly believe all 5 of those, it changes everything.
It leads to what he calls the carefree state of mind. Not careless, but carefree. Calm. You've accepted the nature of the game.
How does it help practically?
Well, it removes the emotional risk. If anything can happen, you're mentally prepared for any outcome, win or lose. No shock, less emotional reaction. It also kills FOMO, fear of missing out.
Because there isn't one perfect trade.
Exactly. There are countless opportunities for your edge to play out. If you miss one, another will come along. So you just focus on executing your plan when the conditions are right. No chasing, no forcing.
And your expectations become more realistic based on the stats of your edge, not just hoping to double your account by Friday.
Precisely. Realistic expectations based on probability. But the big question is, how do you actually get your mind to accept and operate based on these truths?
Yeah, knowing them intellectually is one thing.
Living them is another, and that's where chapters 8 and 9 come in, understanding and actively working with your belief.
Beliefs are the key mechanism here.
Absolutely. Our beliefs are like the operating system of our mind. They determine how we process information, what we expect, how we feel, and what we do. And crucially, beliefs are learned.
They aren't innate. We pick them up from experience, culture, family.
Right. And while they feel like the truth to us, they are just our truth. Someone else can hold the exact opposite belief just as strongly based on their experiences. Beliefs are subjective maps of reality, not reality itself.
And they actively shape our experience.
Massively. They filter what we even perceive. They create expectations that influence our actions. They determine how we interpret results.
Like that example he gave, the free money on the street.
Perfect example. People literally didn't see it or dismissed it as fake because their ingrained belief nothing in life is free was so strong it overrode the evidence right in front of them. Their belief filtered their perception.
So in trading, destructive beliefs, like I'm just unlucky, or I have to be right, or losing is failure.
Or trading is just gambling, the market is rigged against me. All these beliefs are in direct conflict with the mindset needed for probabilistic thinking and consistency.
And they become self-fulfilling. If you believe you're unlucky, you might subconsciously sabotage trades.
Or interpret random losses as confirmation of your bad luck, reinforcing the belief. It's a cycle. So the first step is identifying your specific limiting beliefs related to trading, money, risk, success, failure.
And the good news is, beliefs can be changed.
Yes, but it takes conscious effort. Douglas suggests the solution often lies in deliberately adopting the opposite belief to the one causing the problem.
So if you fear losses intensely,
you need to actively cultivate the belief that risk is inherent, acceptable, and simply the cost of doing business in a probabilistic environment. You work on accepting risk.
if you're arrogant after wins,
You need to deeply install the belief in fundamental uncertainty, that you don't know the future, that anything can happen on the next trade.
but changing a belief isn't like flipping a switch.
Definitely not. It requires, first, awareness, then a genuine desire to change, and then consistent conscious practice of the new belief. Acting as if it's true, reinforcing it through thought and action, challenging the old belief when it pops up. It takes time and mental energy.
It sounds like that sculptor analogy again, chipping away at the old ingrained patterns.
Exactly. It requires real, honest self-reflection to even find those beliefs sometimes. They can be hidden.
Okay, so let's try and synthesize this whole journey Mark Douglas lays out, the path to the zone.
Right. It starts by recognizing that technical and fundamental analysis alone aren't enough. You have to address the psychological dimension,
Then understanding why trading's freedom is paradoxically so challenging, leading to issues with rules and responsibility.
which forces you to embrace absolute 100% responsibility for every single outcome. No blaming. That's the foundation for learning.
From there, you work on building consistency as an internal state of mind, not something you get from the market. Mastering fear and euphoria.
Which requires learning to perceive the market objectively, without the distortion of past emotional baggage or future hopes. Debugging your mental filters.
And achieving that objectivity hinges on truly, deeply accepting the market's probabilistic nature, internalizing those 5 fundamental truths, especially anything can happen.
And the mechanism for integrating all of this is the conscious work on your belief system. Identifying limiting beliefs and actively replacing them with beliefs that support probabilistic thinking, acceptance, and discipline.
This isn't just theory, is it? It's a practical, step-by-step process for rewiring your own mind.
It absolutely is. It's internal work designed to change how you think, perceive, feel, and ultimately act in the market.
And the end goal of all this effort, reaching the zone.
Yeah, that state where you're operating almost effortlessly. Calm, objective, disciplined. You execute your edge consistently without emotional interference, accepting whatever the market delivers on any single trade.
Because you have total confidence in your edge over time, and you've accepted the randomness of individual outcomes.
That's the essence of it. Trading in the zone.
So wrapping up this deep dive into the early parts of trading in the zone, what's the absolute core message?
I think it's that consistent trading success is fundamentally a psychological game. It's about shifting from a mindset of prediction and needing certainty to one of probabilities, acceptance, and self-mastery.
And internalizing those key ideas,
Yeah.
taking responsibility, accepting uncertainty, really believing anything can happen, and thinking like that casino operator.
Yeah, focusing on the process and the probabilities over a large sample size, not on the outcome of the next individual event.
It really sounds like the journey Mark Douglas outlines isn't just about learning charts or strategies, but about learning about yourself.
Deeply. It's a process of self-discovery, confronting your own psychological patterns, and actively choosing to reshape your mindset. It requires ongoing discipline.
Okay, here's a final thought then, something for you, the listener, to maybe chew on. These principles, Douglas discusses how our beliefs shape perception, create expectations, drive behavior, influence feelings. They obviously apply way beyond trading, don't they?
Oh, absolutely. They apply everywhere in life.
So think about this. What core beliefs might you hold about success or failure or risk, or maybe what you think you're capable of? And how might those hidden beliefs be quietly shaping how you see opportunities, make decisions, and feel about outcomes in other parts of your life, completely away from the markets?